Everyone thinks markets move because of headlines. They don't. On April 7th, a ceasefire was announced, and instantly the narrative was simple. Peace equals higher markets. The next morning, stocks ripped. The S&P jumped over 2%. The Nasdaq pushed close to 3%. The Dow surged more than 1,000 points. Within weeks, markets were back near record highs, and the explanation everyone ran with was the same: relief rally. But that explanation breaks the moment you look closer, because while markets were moving up, the underlying situation wasn't nearly as stable as people thought. Key trade routes were still disrupted, tensions hadn't fully disappeared, and uncertainty was still sitting in the system. So the real question is, if nothing was fully resolved, then what actually moved the market? To answer that, you have to rewind, because going into this event, Wall Street wasn't calm, it was under pressure. Markets had been falling for weeks. Major indexes were down sharply, volatility was rising, and beneath the surface, positioning was getting extreme. Hedge funds weren't just adjusting, they were selling aggressively. Prime brokerage data showed one of the fastest paces of selling in years. Leverage across funds was sitting near extreme levels. Short exposure to major indexes had climbed close to pandemic-era highs. Sentiment was clear. The market was leaning heavily bearish. Then came the announcement, and when markets opened the next day, everything flipped. Prices started rising fast, and that's where the first domino fell. Because when you short a stock, you borrow shares and sell them, hoping to buy them back cheaper later. But if the price rises instead, you're forced to buy those shares back at a loss. And when that happens across the system at scale, it creates forced buying. That buying pushes prices higher, which forces more short sellers to cover, which creates even more buying. That chain reaction is a short squeeze. And that's exactly what started happening, but that was just the first layer, because once prices began moving up, systematic traders stepped in. These are rules-based models. They don't react to news. They don't care about geopolitics. They follow price. When the trend is down, they go short. When the trend flips up, they go long. And once key levels were crossed, those systems flipped direction, not slowly, aggressively. Tens of billions of dollars in positioning had to be reversed in a matter of days. That's the second domino. Then came the third, the options market. When traders pile into call options, dealers on the other side have to hedge. To stay balanced, they buy the underlying stocks. So as prices rise, they buy more. That buying pushes prices higher, which forces even more hedging. Another feedback loop. Now you have three forces hitting the market at the same time. Short sellers being forced to buy, algorithms flipping long, dealers buying to hedge, all stacking on top of each other. That's the rally, not peace, not headlines, not fundamentals suddenly improving overnight, just positioning unwinding itself. And this isn't a one-time event. You've seen this pattern before. Different headlines, different catalysts, same mechanics underneath, because the structure of the market has changed. Years ago, markets were driven by people, analysts reading reports, investors making long-term decisions. But today, a massive portion of the market runs automatically. Passive funds allocate based on size, not value. Algorithms react to price movements. Options flows force real-time buying and selling. So when a move starts, it doesn't stay small. Reactions stack, momentum builds, and price accelerates far beyond what fundamentals would justify. That's why markets can rally even when the world looks unstable. Because price isn't always a reflection of reality. Sometimes it's just a reflection of positioning. And once you understand that, these moves stop looking random. They start making sense. So next time you see markets ripping on a headline, don't just ask what happened. Ask who was positioned the wrong way and who was forced to react, because that's where the real story is. And if you want to keep breaking down markets like this, hit subscribe and build this understanding with me.